Welcome to the deep dive. Our mission today is it's pretty laser focused, and frankly, it's critical for anyone even remotely interested in Caribbean real estate.
hmm
We are going to cut through all the noise of the property listings, and really try to extract the practical, grounded truth about the Jamaican residential market.
It's so necessary.
We're moving beyond the anecdotes, past all the glossy pictures of infinity pools, and we're focusing on the hard data, where people are actually building, where they're buying, and what the market truly values right now.
And for you, the learner, the goal here is not just to be informed, it's to be thoroughly informed and quickly.
Right.
We've sourced excerpts from this massive, really detailed real estate market analysis, and we're going to use a very rigorous, data-driven approach to avoid that trap of just information overload.
Yeah, you see 1,000 listings and your eyes just glaze over.
Exactly. And what we found, the core insight really, is that Jamaica's housing market isn't a single unified story. You can't sum it up in one neat sentence.
That's so true. It's moving as three distinct, almost independent narratives. It's like a three-act play unfolding across the island.
A three-act play is the perfect way to put it.
The market is segmented.
Yeah.
And understanding those segments, well, that's the shortcut to understanding value.
Precisely. So we've structured this entire deep dive around those three acts. Act one is the foundation, the broad middle.
Okay.
That's family homes and townhouses. It's where most established families kind of picture their lives.
The traditional dream.
The traditional dream, yes. Act two is the patient money. It's the directional arrow for the future. We're talking about land,
Where people are placing their bets.
where buyers and developers are placing their long-term bets on future growth. And then there's Act three, which is the market's modern spine. That's apartments and hotel apartments.
Which feels like it's driven by a totally different logic.
A completely different logic. Security, flexible lifestyle demands, and global investment logic. It's a different animal.
Okay, so let's unpack this. Before we can even dive into Act 1, we have
Yeah.
to talk about the methodology because we're dealing with, vast amounts of data here.
We are.
And if we just look at a simple average price, our understanding could get totally warped by outliers, right? That one massive mansion on the hill or some distressed sale in a remote area.
It would be completely skewed.
We're trying to find the market's true center of gravity, not its extremes.
That is the essential starting point. We absolutely need robust benchmarks, and that means we are filtering out all the statistical noise, the outliers, to get a picture of the typical flow of the market.
So you're just ignoring the crazy high and the crazy low numbers.
We are. We're ignoring the ultra-luxury one-offs and those suspiciously low prices that are, they're likely tied to listing errors or very specialized distressed cases.
So how do you define typical? And the market span is so wide. How do you actually do that?
We get that definition by focusing strictly on the middle 90% of listings.
Middle 90. Okay.
We physically cut off the top 5% of the most expensive properties and the bottom 5% of the least expensive properties. This methodology gives us a much cleaner, more representative view of the mainstream market. It really reduces the distortion.
That's so crucial because if you have, say, 100 listings and just 3 of them are priced at $500 million, the normal arithmetic average suddenly becomes meaningless for the person looking to buy a $60 million home.
Absolutely meaningless. The extreme ends can pull that average in a really unhelpful direction.
Right.
So by using this middle 90% filter, we can rely on 3 key metrics throughout this whole discussion. The first is the median.
Okay, the median, the exact middle listing.
The exact middle. 50% of listings are below it, 50% are above. It's a rock-solid number.
And the second?
The trimmed average, which is the average of that remaining middle 90%. It just further reduces the influence of any, internal extremes that are still left.
I see. And the third?
And the third is just the typical middle range itself, the floor and the ceiling of that 90%. So from the 5th percentile to the 95th, those 3 points together, they set our analytical stage.
Fantastic. So let's get into it. Let's look at the benchmarks for our 3 narratives. We need to set the financial baseline for this entire deep dive.
Okay, starting with Act 1, houses and townhouses. The foundation of the market.
Right.
The typical middle range for a detached house or a townhouse, it stretches from a starting point of approximately $15.5 million up to $174.3 million.
Wow. That is a massive range. It really shows the breadth of the conventional housing market.
It's huge.
So where does the center of all that action actually sit?
Well, the median price for a house or townhouse is approximately $47.5 million.
47.5, okay.
And the trimmed average is a bit higher, which tells you the data still leans a little toward the premium side. It's around 56.6 million.
So the practical translation for the listener is what? What should they be thinking?
The translation is that the center of gravity for family homes and townhouses is robustly within the $40 million to $80 million band.
40 to 80.
Yes. If you are buying or selling in Jamaica and you are not looking for, absolute entry level or super luxury, this is the most common price environment you are going to encounter. This is the market's anchor.
That sets a very, very clear expectation for traditional housing. Now, let's pivot. Let's go to Act 3's market. Apartments and hotel apartments.
Okay.
My gut says these should be more expensive because of location, but what do the numbers actually say?
Well, this is where we hit our first big narrative twist.
Oh,
The typical middle range for apartments is 24 million to 238.5 million.
okay, wait. So right away, the lower entry point is 24 million. That's substantially higher than the 15.5 million we saw for houses.
It's a huge difference. That is a significant barrier to entry for vertical living right from the start.
It really is. So what about the medians?
The median for apartments is about $50 million.
50.
And the trimmed average comes in at 60.1 million.
Hang on a second. I need to zoom in on that. That's an inversion. The median price for an apartment at 50 million is slightly higher than the median price for a house, which was 47.5 million.
There it is.
This completely flies in the face of the conventional wisdom that apartments, in most global markets, they're the budget alternative.
That is the core insight that defines the modern Jamaican urban and resort market. It absolutely proves that apartments are not the budget option.
They're not the cheaper way in.
No, they compete directly, and in many cases, they command a premium over detached houses.
But why? I mean, if I can get a bigger physical footprint, more land for less money further out, what am I actually getting for that extra 2.5 or 3 million on the median?
You are buying what we call the layered bundle. The price reflects a lot of non-physical attributes. You're buying proximity to job centers, you're buying security-gated access, 24/7 guards, robust infrastructure like backup power, backup water,
The peace of mind stuff.
the peace of mind stuff. You're buying amenities, communal pools, gyms, roof terraces, maybe even concierge services. And crucially, especially on the North Coast, you are buying a managed asset, something designed for investment and rental returns.
Right.
So the cost of that vertical living in that prime packaged environment, it outweighs the cost of a detached, unmanaged house that's further afield.
So the price tag isn't just for the concrete and the steel, it's for the guaranteed lifestyle and the removal of all that maintenance hassle. That's a huge shift in how people perceive value.
It really is. Now, let's look at Act 2, land. This is the ultimate wild card.
Okay.
The typical middle range is the widest of all three. It stretches from about 6.5 million up to 275.8 million.
6.5 million. That's the most affordable entry point we've seen in the middle, 90%.
Yeah.
But that spread is it's absolutely enormous.
Yeah, it's vast. And the median for land is predictably the lowest. It's about $19 million.
19.
And the trimmed average is 36.6 million. Land is cheaper on the median, for sure, but its value is so intensely context-driven. That's why we call it the category with the widest personality swing.
A personality swing. I like that.
That 19 million median is heavily influenced by, modest single residential lots. But the upper range, pushing toward 275 million and beyond, that is purely driven by large development tracts.
Which are, as you said, business plans with boundaries.
Exactly.
Okay, so we have three distinct financial DNA profiles. Houses are anchored in that $40 to $80 million range. Apartments are a premium lifestyle choice. And land is the future investment that ranges from an affordable lot to a massive development asset.
That's the landscape.
Let's move into Act 1 then. Houses and townhouses.
This is where we analyze the sheer volume of transactions and listings. It reveals the market's everyday rhythm and, the broadest spread of family needs.
So where is the housing market physically most active? I mean, in terms of just the raw number of listings.
Our source data gives us a very clear top 10 by listing count. And the busiest areas are fascinating because they demonstrate that clear difference between volume and value.
Okay.
The top 3 busiest areas are Mandeville, Montego Bay, and Spanish Town.
Let's put those in context for the listener. Mandeville is inland, in Manchester, a major regional hub.
Right. Known for its cooler climate, returning residents.
Montego Bay, obviously the tourism capital, the second city, and Spanish Town, historic capital, just west of Kingston, a massive commuter nexus.
That's the perfect geographical context. Now, let's layer on the pricing. Mandeville shows a typical median around $55 million.
55, okay, that's right in that sweet spot we talked about.
It is. Montego Bay is close behind at $52.7 million. But Spanish Town, it dips to a much more affordable median of $35 million.
And that immediately illustrates our first major point here. Volume does not equal luxury.
Not at all.
Spanish Town is a high-volume area, but it's clearly focused on practical, attainable housing for the broad, middle, and working-class segments. It sits well below that $47.5 million national median for houses.
And we see this pattern repeated across other high-volume, practical housing hubs, like Maypen in Clarendon. It has a median of $27.5 million.
Even lower.
And Old Harbor in St. Catherine sits at $35.7 million. These are the areas doing the heavy lifting in terms of volume. They're supplying practical housing for growing families, for commuters using the new highways.
But within that volume list, there is one giant exception that really demands our attention.
Absolutely. Kingston 6 is fundamentally its own economy.
It's its own ecosystem.
It really is. It appears in the top volume list, so there's significant supply turnover. And it maintains a dramatically high median price of $190.2 million.
$190 million. It's in a different universe from the other high-volume areas.
It's the definition of a prime pocket, where desirability is so intense that density and high price just coexist. It seems no amount of supply can quench the demand for that specific address.
Let's define those premium house corridors more clearly then, by looking at the highest medians. Where is the trophy residential pricing really concentrating?
The premium corridors, they form a distinct, very familiar triangle that anchors the top of the market.
Okay.
Leading the charge, of course, is Kingston 6, with its incredible $190.2 million median.
Untouchable.
Pretty much. Just outside that orbit, but still firmly in the nine figures, is Ironshore, near Montego Bay. It's coming in at a median of $110.9 million.
Okay, the resort corridor.
And right behind that is Kingston 8 at $100.5 million.
So we have the ultimate prime urban core in Kingston 6. We have the prime resort-adjacent luxury of Ironshore. And then the established upper residential area of Kingston 8. It's a triangle defined by perceived stability and, let's be honest, social standing.
That's a huge part of it. The key differentiating factor here isn't just the house itself. It's the inherent value of those locations, the scarcity of land, the prestige, the established security protocols, and crucially, the social infrastructure.
What do you mean by social infrastructure?
Access to the best schools, the best hospitals, the high-end commercial hubs. Those factors anchor the prices firmly in the hundreds of millions. You're buying into an established community.
Now let's pivot to the other side of the scale. The areas that offer more, space per dollar. Where are the affordable clusters, the high-volume areas offering that pragmatic value?
Well, the three most approachable medians among areas with statistically meaningful listing volume are Greater Portmore in St. Catherine at $26.5 million.
26.5, okay.
Maypen, again, at $27.5 million.
Yep.
And Santa Cruz in St. Elizabeth at $30 million.
These areas offer a really clear value proposition for the learner. They're not cheap properties in absolute terms, but relative to those prime corridors, they represent affordability. And that affordability is usually achieved by accepting a longer commute or trading off immediate access to the Kingston Metropolitan Center. That is the practical choice so many families are making to maximize their square footage.
The market is signaling the long-term viability of these commuter belt and secondary urban centers. They have their own services, their own economies, and buyers are willing to use the improved highway networks to trade time for space and affordability.
The logical trade-off. Okay, let's move to the bedroom factor, because this is where the market really reveals its priorities. We've filtered the data, and houses and townhouses are dominated by 2 to 5 bedroom stock. So what do the median prices tell us about the perceived value of an extra room?
Well, the initial data is exactly what you'd expect. It shows a typical progression. A 2-bedroom house typically sits around a $37 million median.
37, okay.
A 3-bedroom is a clear and expected step up to a $55 million median. So you would logically expect the 4-bedroom price to keep going up from there.
Of course. Should be what, 70 million? 75?
You would think. But the data shows this really counterintuitive finding. The four-bedroom median drops back down to about $40 million.
Wait, what? 40 million? That's a massive dip. That's $15 million less than the three-bedroom median. Why on earth would a house with more bedrooms cost significantly less?
This is perhaps the single most important finding in Act 1. This is the composition effect at work.
The composition effect.
This dip proves definitively that location and what we call finish level are doing the heavy lifting, often more than sheer size.
Okay, explain the composition effect for us. Walk us through it.
Think of it like this. The supply of four-bedroom houses, while they offer more space, is predominantly located in those mid-market or more affordable parishes we just discussed.
Spanish Town, Maypen, Santa Cruz.
Exactly. These are large, robust family homes that are priced for their immediate local market. Very practical.
Okay. Meanwhile, the three-bedroom stock, which commands that higher 55 million median, is disproportionately located where?
In the prime desirable areas. Kingston 8, Mandeville, the prime sections of Montego Bay.
Ah, I see it now.
So the data is telling us that the average three-bedroom house is sitting on more expensive land in a better serviced area and probably has a higher standard of finish than the average four-bedroom house.
So a well-located three-bedroom unit commands a higher price than a larger, less centrally located four-bedroom unit. That is a powerful market signal.
It's a huge signal. It tells us that for the typical Jamaican buyer, location and perceived quality are the primary drivers of value, not size alone.
That insight fundamentally shifts how a buyer should be looking at the market. You should be prioritizing the address over the square footage.
Absolutely. And if we then look at the true luxury end, the 5 to 7 bedroom stock, the price returns to that $55 to $60 million range. And the limited listings for 8-bedroom properties, they jump sharply to an 86 million median, which indicates these are typically very large, multi-generational or higher specification homes, even if they're located outside those prime Kingston pockets.
To wrap up Act 1, let's define the realistic boundaries. What are the entry and exit points for a traditional family home?
At the very top end, the exit point is in the hundreds of millions, firmly anchored in those prime St. Andrew and Kingston 6 addresses. This is where status and legacy are bought and sold.
And the most affordable but still reliable entry point, staying within that statistically sound middle 90%.
That entry point begins around $15.5 million. That's the lower edge of our trimmed data set.
And where would you find those?
Typically, these are single-family homes found in emerging areas of St. Elizabeth, Manchester, and St. Catherine. Solid, practical homes.
So the practical takeaway for the learner is crucial here. While the starting gun for the reliable market fires in the mid-teens, the market's true center of gravity, where most of the deals are happening, is much, much higher. It's in that $40 to $80 million band.
Buyers need to calibrate their expectations accordingly. Act 1 shows stability and segmentation based on location and utility. Now, we shift to Act 2. Land. If houses are the present, land is the market's quiet confidence. It's whispering its future intentions.
And the median land price is $19 million, which, as you noted, is almost entirely misleading because of the context.
Highly misleading. Land is the category with the most variance. A $19 million listing could be a small quarter acre on a side street, or it could be a raw tract of acreage destined to become a massive housing community.
Right.
Since land listings represent a business plan with boundaries, we have to look beyond just the median price and see where the demand is clustering. Where is the activity?
So if we look at the sheer volume of listings, where is the most demand for future development or personal building actually happening?
The top 10 volume areas reveal a really fascinating pattern of what we call dual demand.
So dual demand, okay.
Topping the list is Treasure Beach in St. Elizabeth with a median price of $16.1 million. It's followed by Red Hills, an urban edge community just outside Kingston, at $20 million. And Mandeville, again, proving its stability at $15 million.
That split tells a story right there.
Yeah.
You have Treasure Beach, which is a classic coastal and lifestyle area.
Very bohemian, very rustic chic.
Right next to Red Hills, which is all about proximity to the capital.
Exactly. We see two distinct drivers for land acquisition. First, the lifestyle and coastal demand. We see that in areas like Treasure Beach, Runaway Bay on the north coast with a $17.4 million median, and Falmouth in Trelawney with a $23 million median.
So these are buyers looking for personal lifestyle, retirement potential, maybe future tourism investment.
That's the profile. And then the other side of that coin is the relentless urban edge and commuter belt demand.
Urbanization push.
The urbanization push. This includes Red Hills, Kingston 19 with a 30 million median, and critically, Kingston 8. Even in the raw land category, Kingston 8 holds a strong premium at 70.5 million.
So these are buyers looking for the last available plots with proximity to services, or they're looking for a solid base for future high-density housing developments.
That's right. And we also see the extremely practical value-seeking buyer in that volume list, too. Maypen appears again, but its land median is the lowest of the entire group at just 6.5 million.
Wow.
That Maypen data point represents the extremely affordable entry into land ownership. It signifies a consistent volume of transactions for smaller, maybe less ideal parcels or land that needs substantial future investment in infrastructure. But it meets that basic need for ownership.
Let's talk about the extreme divergence in land pricing, because this is where the big money signals are. We saw that $275 million cap on the middle range. What are the premium land pockets signaling intense development pressure?
The pricing structure for premium land is just. It's dramatic, and it signals deep capital commitment. While Kingston 8 holds a very strong urban premium at 70.5 million, the clear outlier in the source data is Discovery Bay.
On the North Coast.
On the North Coast,
Wow.
with a staggering median price for land of about $124 million.
$124 million. That is nearly 3 times the price of the national median for a developed family home. What on earth drives a median price of $124 million for raw land in Discovery Bay? That needs serious explanation.
This is the definitive signal of strong development appetite and an intense coastal premium for specific, large tracts of land.
So this isn't for a single family.
No. This land is priced for global investors, not for a single family looking to build one house. It signals that developers are actively chasing large-scale coastal opportunities that are already titled, that likely have good road access, and are suitable for luxury housing projects or resort expansion. The price is dictated by its projected value once the vertical construction is complete.
So to put that into perspective, the price of entry into development-grade land in a prime coastal area like Discovery Bay is equivalent to buying 2 of the most luxurious houses in Kingston 8. It's a completely different game.
A completely different league. And conversely, if we look at the affordable end, we mentioned Maypen at 6.5 million. We also see Spanish Town at 9.2 million and Kingston 7 at 9.7 million. These are still high-volume transactional areas.
So what should the learner understand about these lower-priced parcels? What's the catch?
Well, they often imply one of 2 things. Either the parcels are much smaller or in less prime site positions, on a steep hill or with difficult access.
Right.
Or, critically, they are land that requires significantly more investment from the buyer after the purchase.
What kind of investment?
More complex surveying, clearing the land, navigating infrastructure connections, power, water, sewer, or dealing with complex regulatory approvals to get building permission. The low price reflects the inherent complexity or the future expenditure the buyer has to take on.
So what is the land inventory truly revealing to us about the directional arrow of the market? Where is it pointing?
It's revealing 2 critical things about future growth. First, that dual demand for coastal and urban edge land confirms where the next major housing supply waves are going to emerge. Developers are chasing proximity to either the sea or the city.
Okay.
And second, and maybe more strategically important, the gap we observed between regular land and development land is immense.
Mm-hmm.
This massive price divergence suggests that infrastructure investment will increasingly determine where prices blow away. A lot with existing utility access and proper titling is far, far more valuable than raw acreage, and that price difference is only going to widen.
Land is the ultimate future indicator because it shows where people are prepared to sink serious long-term capital based on projected value, not what's there right now.
It is the clearest available signal about where growth is headed over the next 10 to 20 years.
All right, let's transition now to Act 3, apartments and hotel apartments, which you call the market's modern spine. This market is arguably the most complex of the 3.
It is, because it layers in so many factors beyond just location and size. We talked about apartments being both simpler and more sophisticated at the same time.
Simpler because they fulfill that modern lock-up-and-go mentality. It's ideal for executives, younger professionals, maybe snowbirds. It's low maintenance.
Right. And more sophisticated because the pricing is that layered bundle we discussed. You are purchasing a unit within a managed structure. So the price is dependent on the building quality, the brand reputation, the level of security, the specific amenities package,
And the rental potential.
and crucially, the projected rental performance, especially in those North Coast areas where units are often run as short-term rentals.
That sophisticated packaging is what drives that slightly higher median price compared to houses nationally. It's a value proposition of convenience over pure physical space.
Correct. The buyer is paying for time saved and security purchased. At the end of the day, that's what it is.
So where is the apartment market clustering? Where is the highest volume of vertical living?
The apartment market is geographically very highly concentrated. It reflects intense demand in specific high-access zones. The listing volume is led by Tower Isle on the North Coast, with a median of 57.5 million.
Okay.
It's quickly followed by the two anchor prime pockets in Kingston. Kingston 8 at 50.5 million and Kingston 6 at 57 million. And Montego Bay also features prominently with a median of 63.4 million.
This clustering strongly defines what you called the two apartment Jamaicas. Let's break those two markets down for the listener.
Okay, so first, you have Kingston's apartment belt. That's basically KGN 5, 6, 8, 10, and 19. This market is driven by urban necessity, work proximity, institutional security demands, and the convenience of high-end urban living. This is where high-income professionals and executives, well, they feel they need to be.
And the second market is the coastal lifestyle and investment zone.
That's the North Coast supply. We see that in Tower Isle, Montego Bay, Ocho Rios with a 51.6 million median, and Runaway Bay with a 53.9 million median. This market is heavily driven by investment logic.
So it's catering to both domestic buyers looking for a second home and the international market looking for hassle-free, short-term rental income.
That's the primary driver.
Okay, let's focus on the premium pricing of these vertical units because the North Coast, it appears, commands the highest prices. Where are the highest medians for apartments?
Among areas with reliable data, the premium clusters show a very clear North Coast signature. It just shows the global appeal of resort living. Miami Bay, which is near Ocho Rios, tops the list with a truly astonishing median price of about $118.9 million.
$118 million. That median is nearly double the median for apartments in Kingston 8. That tells you everything you need to know about the value of luxury vertical living when you pair it with coastal proximity, an ocean view, and resort-level management.
It is the ultimate expression of that layered bundle. These units are priced for a global market. They're leveraging ocean views, private beach access, premium resort services. They're not just competing with other apartments in Jamaica. They're often competing with small, high-end villas internationally.
Right. And what are the other premium clusters?
Laflance is next at 88 million, and Redding, near Montego Bay, comes in at 87.2 million, a clear North Coast premium.
On the other end, where are the most affordable apartment clusters? The ones that allow for a realistic entry into vertical living.
The lower medians show up in areas like Iron Shore at 24.3 million, Spanish Town, again, at 28.4 million, and Mandeville at 34 million.
Spanish Town apartments, again, offering that practical, high-volume living at the most affordable end of the market, driven by the commuter belt. The Iron Shore data is also interesting, a relatively low median for the Mobay area. That probably reflects a mix of older stock or units without those premium resort amenities.
It proves that the apartment market, despite its high overall national median, still provides entry points across the island based on local infrastructure and local demand, not just global luxury.
Okay, now for the final major data point in this act. The bedroom premium in vertical living. Apartments are dominated by 1- and 2-bedroom units. 3 bedrooms are a clear step-up tier. What are the price implications for a buyer considering their options?
The typical pricing is very precise in this category. A 1-bedroom unit sits around $39 to $41 million.
39 to 41, okay.
Proving to a 2-bedroom unit raises the median to about 53 to 54 million.
Okay, that's a reasonable jump. It acknowledges the added utility and capacity of the extra room.
It feels logical, but then look at the 3-bedroom unit. The median jumps sharply to approximately $78 million. 78. That is nearly a $25 million premium over the 2-bedroom median. That's a mathematically significant leap. I need to isolate that finding. Why does adding one more bedroom cost disproportionately more in an apartment than it does in a house?
It's not about the square footage. It's about the segment of the market that it unlocks.
Right.
That meaningful premium you pay for the third bedroom isn't just about space. It fundamentally changes the unit's identity and its potential buyer pool. A one or two bedroom is often a rental asset, right? Good for short-term stays, or a single executive.
Right.
A three-bedroom unit becomes genuinely family capable,
Mm.
or executive capable for a family with children.
So it shifts the market identity from just an asset to an actual home.
Precisely. It makes the unit a viable, long-term primary residence. It accesses a different, higher-spending buyer segment who needs that space for children or for work-from-home offices.
And the supply is lower. The utility justifies the steep price increase because the supply of true quality three-bedroom apartments in prime areas is scarce, and the demand from long-term residents is very high.
That's a fantastic example of how functionality and scarcity, not just size, dictate value in the modern vertical market. It's less about the material cost and more about the sociological utility.
And if we look at the extreme high end, the most expensive apartment listings, even after trimming the extremes, they reach into the 500 million plus band. These are the penthouse units. They're selling status, unparalleled views, brand. At this level, they are competing directly with the top-tier multi-acre houses in Kingston 6 for that ultra-wealthy buyer.
We've now toured all three narratives: houses, land, and apartments, each with its own pricing logic and geographical anchor. Let's move into the synthesis section, the crucial so what for the learner.
Okay. The inventory mix suggests three overarching structural themes about the Jamaican market that you can really use to inform your own decisions.
The first theme is the relentless duality of Kingston.
Yes, Kingston remains two markets in one. The prime pockets, Kingston 6 and 8, show an unwavering willingness among buyers to pay a steep premium for stability, proximity, and that established social infrastructure we talked about.
The established neighborhood identity and services.
Exactly. The fact that there's high listing volume in these areas, yet the pricing stays so firm, it means the underlying demand for that specific stability and prestige is virtually inelastic. Buyers are queuing up for it.
The second theme is the complexity of the North Coast. It is clearly not just one single market.
Absolutely not. The North Coast is profoundly micro-segmented. We saw sharp price shifts between areas that are geographically right next to each other. Miami Bay versus Tower Isle, for instance.
Right.
This volatility is driven entirely by the product mix. Is it conventional apartments versus hotel apartments? What's the density of the amenities? How close is it to major commercial anchors like Montego Bay or Ocho Rios? Buyers have to be granular in their research. Simply saying, I'm looking on the North Coast is insufficient.
And the third theme connects us back to our quiet confidence market, land.
Land is the clearest future indicator. The high-volume clustering in coastal and urban edge areas, Treasure Beach, Red Hills, Discovery Bay, and those rising medians, they foreshadow exactly where the next housing supply wave will form.
So if you want to know where growth is headed,
If you want to know where the government is investing in infrastructure or where developers are committing capital, you follow the high-value land transactions. They are the market's directional compass.
that provides a clear and very nuanced summary of the current landscape. Now, let's look ahead. Based on the inventory patterns we've observed, what are the grounded expectations for the immediate future of the market?
The data supports three key expectations moving forward, which should really guide the learner's strategic thinking.
Number one, the structural competition between property types.
Apartments will continue to compete directly with houses in that mid-market price band. As urban living becomes more critical and security becomes more valued, a $55 million well-appointed apartment in Kingston 8 will be a direct, viable alternative to a $55 million larger detached house in Mandeville or Ocho Rios.
So the utility of the
The
apartment.
utility of the apartment, the lock-up and go, the security, the proximity is now financially on par with the utility of space and quietude offered by the detached home that's further out.
Okay, number two, the further divergence of land value.
Land will remain the most story-driven and volatile category, and the prices will diverge even further between the ordinary and the exceptional. The gap we observed between an ordinary undeveloped lot and a large, fully development-ready parcel.
One that already has approvals, road frontage, guaranteed utility access.
That gap is going to widen substantially. The complexity factor and the speed of buildability are becoming major price drivers. Developers will pay a massive premium to de-risk their investment.
And the third expectation, the consistent reward for quality and presentation.
The market will maintain its highly discerning nature. It will continue to reward ready-to-live property.
Yeah.
Good finish quality, highly desirable location, robust security. Those properties will get fast sales and premium pricing. Conversely, listings that are poorly positioned, poorly presented, or require extensive post-purchase rehabilitation, they're going to sit longer on the market and will require harder, deeper negotiation to move.
So if the market is rewarding quality, convenience, and location stability above all else, what is the final conclusion we can draw from this entire inventory review?
That the market is not collapsing under inflation or geopolitical pressure. It is refining itself.
Refining itself. How so?
It is becoming more segmented, far more discerning about the specific features it values, like that extra $25 million for the three-bedroom utility, and incredibly clear on the price it assigns to stability and convenience. It is maturing into a highly sophisticated market structure.
That brings us to the end of our deep dive. Let's just quickly review the key takeaways for the learner, connecting all the segments we've covered.
We established the three segmented markets: houses, with a stable $40 to $80 million center of gravity; land, defined by its massive potential and volatile spread, acting as the future indicator; and apartments, which carry that significant, sometimes global, lifestyle premium, highlighted by that specific and meaningful $25 million jump for the three-bedroom unit.
And the critical insight we extracted, the one that should radically change how you assess value, is that location often explicitly trumps size. We saw this with that counterintuitive four-bedroom house price dip, which proved that the composition of the market in a given area defines the median price. And of course, the consistent, massive premium commanded by Kingston 6 addresses.
It's a market that values proximity, hassle-free living, and perceived stability above almost all else, and that's evidenced by the willingness to pay more for an apartment than a house.
That structural emphasis on location, on security, and amenities. It leads directly to our final thought for you to explore on your own.
Okay.
Since the price signals suggest a market that is highly discerning and willing to pay an ever-increasing premium for established stability and infrastructure, this is the question. As density continues to increase in those desirable urban centers and coastal hotspots, how much more valuable and scarce will established social infrastructure become relative to pure, raw physical space in the next decade?
And by that you mean things like access to top-tier schools.
Access to top-tier schools, a predictable neighborhood identity, existing, mature gated communities, all those things.
Think about that carefully. It's no longer just about the size of the lot you buy, but the established, non-replicable quality of life that surrounds it. That value proposition may become the single biggest driver of price appreciation moving forward.
Use this nuanced knowledge to inform your own research, whether you're buying, selling, or just observing this dynamic market. That was the deep dive, and we will catch you next time.